topic today is on how investors use the yield curve. The term yield curve is frequently used in the financial markets and in the press. Today, we'll talk about what it measures and what the curve means to markets. But before we get into that, I'd like to plug our upcoming live show. We host a live Zoom webinar each quarter to discuss trends impacting the market. I hope you can join the call on Tuesday, April 12th at 3 p.m. or watch the recorded video replay on our blog after. We welcome your questions in advance and during the live webinar. Visit our events page at vectorwealth.com for details. So why are we talking about the yield curve again? Well, when the 10 and 2 yield curve spread has historically inverted, many times an economic recession has followed. Around 2 weeks ago, we saw a brief inversion of the yield curve. To understand how investors use the yield curve, let's first define some terms and get some context. Now, the yield curve is a data visualization where we plot a line on two metrics, maturity and yield, also known as interest rate. We're looking at the maturity and yield of bonds in this case. Now, a bond's term or years to maturity is usually set when issued. Bond maturities can range from 1 day to 100 years, but most bond maturities range from 1 to 30 years. So when we talk about the 10 and 2 yield curve, we compare a 10-year bond yield with a 2-year bond yield. Now, there are many maturity comparisons that could be done. However, the most commonly cited is the 10 versus the 2-year, as these are generally thought of as broad indicators for short and long-term time periods. The yield is the interest paid to investors who buy the bond. The further you go out to the right on maturity within a normal yield curve, the more yield or interest you can expect for taking on a longer term period of uncertainty. Now, when the yield curve is inverted, a longer term bond will sell for less promised future yield than a short term bond. It's not that all long-term bonds have flipped with short. It may be just one term's yield with a younger one. The 10-year maturity bond sold for a slightly lower yield than the 2-year. You'll also notice, by the way, that the 30-year is somewhat lower than the 20-year. When a 2-year bond returns more than a 10-year bond, what is referred to as an inverted yield curve, that is sometimes signaled a recession is on the horizon. Does this year's inversion mean anything? Well, one standalone data set, like the yield curve, is not enough to say. More context is needed. This gets to our next point on who else is involved here. As the US Central Bank, the Federal Reserve can raise or lower short-term interest rates, impacting short-term 3-month yields. If the Fed raises interest rates, it increases the cost of borrowing, making it more expensive and thereby slowing economic activity. Recently, the Fed began increasing short-term interest rates, and they expect they will continue to do so throughout this year. The market is expecting these changes also, which is in part why we see 2-year yields on the rise. Now, this is a very important part. The market for 2-year maturities is rising in part due to the anticipation of the Fed's future actions. The result is the 10-year versus the 2-year yield has inverted momentarily based on these future expectations. Now, this is also important for us to pay attention to. However, it brings us back to the point that one standalone data set based on expectations is not enough by itself to make an accurate prediction of the future. Getting back to our topic, how investors use the yield curve, we can see that the financialized world is made up of relationships. Understanding the incentives and the past correlations can help make sense of it all. A flattening and inverted yield curve is abnormal. And while it can signal stress on the market and the economy, this indicator needs to be evaluated alongside other variables, not just in isolation. Whether the yield curve is inverted, normal, or flat, having a financial plan and a broadly diversified investment mix that anticipates volatility in the short term can open the door for a more patient, long-term investment strategy. As always, we welcome your feedback on this show, and please share your questions for our upcoming live show on April 12th.